Today we're looking at 5 stocks to outperform NVIDIA. Now this is a company that is up 262% over the last 12 months and over the last 10 years up an incredible 19,547%. And now this essential industry has a lot more to grow. As we can see from Bloomberg, they believe the generative AI is going to become a 1.3 trillion market by 2032. And as we can see from this graph down here, they believe the revenue coming from this industry is only going to increase astronomically, which will not just benefit NVIDIA, but also a lot of other semiconductor industry companies. So today we're going to take a look at 5 of the best ones to consider for your portfolio with a lot of room for growth. We're going to look at the historical performance of each one. We're also going to jump into their free cash flows. We're going to look at a lot of their financial metrics to understand the rationale behind their strong growth. And as always, we're going to run them through the valuation model, getting to what we believe to be the intrinsic value, getting to our acceptable buy price given our investor margin of safety, and look towards Wall Street to see what they're forecasting for the next 12 months. Now what we're also going to do at the end of the episode is we're going to run through 2 different semiconductor ETFs, SOXX as well as SMH, to see whether or not these may be a better option for different types of investors. So let's jump into the first semiconductor. We have ACLS. Now this is one that is in fact down 15% over the last 12 months and in fact trades towards its 52-week low. Forward P looking pretty cheap, around 16.53, and over the last 10 years this has grown astronomically, up 1,106%, and we can see it is some way away from its all-time highs of just under $200. So let's take a look at this company. Now in terms of the free cash flow, we want to see growth over the longer term. Negative 61 cents in 2014. 2023 looking very strong, 416. So over the longer term, whilst we do know inconsistencies, it is growing over that period. And in 2024, they are expecting it to nearly double, nearly 100% growth of that free cash flow of 2023. So lots to be bullish about so far. In terms of their top line revenue growth as well, we typically look for 3 to 7% as a base for a minimum. What they've just done over the last 4 years, strong double-digit growth to their top line. So we can see they are growing their revenue at a very rapid rate. And for those that like to look at numbers, well, they have gone from 200 million in 2014 to 1.13 billion. So again, revenue is increasing very rapidly. Free cash flow per share is also moving in the right direction. Now, one thing that we do note, shares outstanding, we can in fact see that they have diluted your position over the longer term by issuing shares. Although we do note, for example, 21 to 22, where they did do some share buybacks. Although the net point of this whole thing is a net dilution, bear in mind though, you would essentially be getting a much better share price return over the last 10 years, so this might not have worried you that much. ROIC, return on invested capital, we do personally want to see a minimum of 10% or more, just to give us faith that management are able to effectively allocate their capital. And what we can see here, pretty strong. Not only has it been increasing over the last 10 years, but the last 2 years, in the fact high 20s, looking very strong, 29, 28%. So this is a very positive metric for this company. Operating margin also been increasing over the last 10 years. We have that sign of operational efficiency, 23 to 24% over the last 2 years, a fairly positive sign. And the same to be said for the free cash flow margin, increasing over the longer term. And even the 12% in 2023, whilst it has dropped from 2022's number, still looking like a very solid metric. Net debt to EBITDA, absolutely fantastic. This is the earnings before interest, tax, depreciation, amortization. Shows us 2 things. 1, in fact, the balance sheet strength, and 2, the dividend safety. Now, this company doesn't pay a dividend. However, others that we will analyze in today's episode do pay a dividend. These effectively signal the number of years it would take the company to pay off all of their debt net of cash on hand. In fact, it wouldn't even take them 1 day in 2023. The same is expected in 2024. So we can see they have a very solid balance sheet. So let's jump into the valuation of ACLS, and typically on the channel we do run through and do deep dives and run through every single model. Today's episode, let's jump straight into the valuation. And if you do enjoy this content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So we get to an intrinsic value of $203. Margin of safety, bear in mind we do start off with around 10% and we use that if it meets 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. So we can see, if you believe that, for ACLS, essentially a margin of safety of 10% of a buy of $182. We keep going till it's near the current trading price, and we can see it does have a very high margin of safety, even having 35%. So we keep going, and for today's episode, we can see pretty much bang on around a 45% margin of safety. In terms of Wall Street and their forecast, well, they see upside of 62% with a price target of $181. Now, out of the other stocks we are looking at today, this is one of them that I am most bullish on. We can see a lot of good financial metrics and some very strong upside from Wall Street of 62%. As always, do let me know your thoughts on these stocks as we run through them today. Now, just before we move on to the next one, just to let you know, we have released our latest free weekly article. If you want to gain access to this, as well as other articles, all completely free, click on the pinned comment below to sign up and you gain instant access. The next company we're looking at to outperform NVIDIA, we have Advanced Micro Devices. Now, they are up 143% over the last 12 months. We can see they had a slight pullback, in fact, but they are still heading towards that 52-week high. Their forward P sitting around just under 57 with a market cap of $335 billion. If you've been holding this over the last 10 years, you would be up a very strong 5,287%. And when we take a look at some of their metrics, we can see free cash flow increased from negative 25 cents to 69 positive. We do note there are inconsistencies over the longer term. Nonetheless, not only moving in the right direction, but 2024 they are expecting some extreme growth to that free cash flow around $3.30. On top of that, their sales growth has been very impressive, double digit nearly every single year, although we do know in the more recent year they did have a negative 4% drop to their top line. But numerically speaking, we can see the absolute increases they've had over the period, going from $5.5 billion in 2014 to $23 billion in their latest period. Similar to the previous company, we do, however, see they have diluted your position from 768 million shares to 1.63 billion. But always do bear in mind, take into account the share price return over the last 10 years has been astronomical, so you wouldn't really be bothered if you were a shareholder in 2014. ROIC now pretty inconsistent. Whilst we look for 10%, we can see over the last 2 years they have struggled, with the last best year, 2021, at 45%, looking very strong. Something just to consider and keep an eye on. We do really want to see a minimum of 10%, but again, given the past has looked very strong, it is definitely something to keep your eyes close to. Operating margin pretty inconsistent. Whilst their top line is increasing rapidly, we do see they are struggling to have a very nice operating margin. At a minimum, we want to see 7%. They have struggled over the last 2 years. Nonetheless, we do see a very strong period from 2018 to 2021. So again, something just to keep your eye on. Free cash flow, we want to see a minimum of 5%. We do see that in the more recent period, and over the last few years coming in very decent for AMD. Net debt to EBITDA as well, nothing really to note here. Over the last 5 years, and in fact 2024 expected, we are looking at a net debt to EBITDA of 0. Again, remember, that is a very, very strong number. They have a phenomenal balance sheet and wouldn't even take them 1 day to pay off all of their debt net of cash on hand. Now, in terms of the intrinsic value for today's episode, we can see that it is essentially just the DCF model, coming to $268. Now, with the current trading price of $205, again, we start off with the 10% margin of safety, and this level will really be different depending on the individual investor themselves, their thesis, their risk profile as well. So we can see for today's episode, it isn't quite there yet at a 25% margin of safety, so we see between 20 to 25%. In terms of Wall Street and their forecast, well, they have a price target just under our intrinsic value of $260. They see upside of 27%, similar to ACLS stock. They do see this as a very strong buy. Just remember as well, you can grab a copy of this valuation model if you want to get to the intrinsic value, as well as the acceptable buy price of companies in your own portfolio or those on your watch list, or even if you want to run through these companies yourself based on your own estimates and judgments. The next company we are taking a look at is ON Semiconductor Corporation. Now, they're down 5% over the last 12 months. Over the last 10 years, however, they are up 767%. We can see their all-time highs around $105 last summer, and they are trading towards the mid to lower end of the 52-week range, with a forward PE sitting around 18.4 and a market cap of around 34 billion. When we take a look at the metrics, free cash flow per share looking very strong, 38 cents in 2013, 369 in 2022. Now we can see in 2023 they are expecting that to drop. However, 2024 a nice strong rebound. So what I like to see here is over the long-term horizon it is moving in the right direction, but again it can be something you can keep a close eye on. Sales growth, double-digit increases every single year, bar the few years where we see negative growth. 2022 at 24%, 2021 at 28%, although we do want to point out that 2023, their annual report is expected to show around 3% growth, so something just to consider and factor in when you're looking at that margin of safety level. Numerically speaking though, we can see they've pretty much tripled their top line over the last 10 years, 2.8 billion to 8.33, and we can see 2023 expected to be relatively flat. Shares outstanding, now it looks very inconsistent. They've done both share buybacks, they've also issued shares. Over the long term, the last 10 years, they have bought back around 2 million worth of shares, so nothing really to note, fairly trivial in fact. ROIC, nice to note, over the last 3 years, looking very strong. Even before then, on average, I would say this is a fairly decent company with respect to their ROIC number. Even the 24% expected from their 2023 accounts is very, very positive. Operating margin, again, another signal or another company, in fact, with operational efficiencies. 9% operating margin in 2013, 33% in 2022, and even the slight dip to 32% in 2023 does look very strong for ON Semiconductors. A pretty similar story to be said on the free cash flow, even at that 6% level, which is fairly decent in 2013. It has been increasing year on year, 20% over the last 2 years. Although we do note the dip to 7% in 2023, still very positive, and I would say their margins overall are looking very attractive. Net debt to EBITDA, where we really want to see for semiconductors, ideally below 1.5. 1 in 2021, gone below that in 2022, and even with the increase to around 0.36 expected in 2024, no worries based on this information while looking at that balance sheet. So again, all companies we've seen so far looking very healthy when analysing their balance sheet. Remember as well, if you do enjoy the content, do smash that like button and do hit that subscribe and bell button, just so you do get a lot of these videos right on your doorstep when they are delivered. Intrinsic value then sitting at $97 with the current price just under $79. Margin of safety 10%, a buy up to $88. 15% 82.66, and at 20% not too far off, around the dollar shy, so we can comfortably say it has around a 20% margin of safety based on the current trading price at today's date. In terms of Wall Street and their expectation, well, they pretty much have a price forecast of around our intrinsic value. They see 24% upside over the next 12 months, making this another very strong stock to add to your portfolio, or at a minimum to put onto the watch list. So 3 very strong stocks covered so far with some very nice upside over the period. The next stock that we are looking at is Marvell Technology. Now, over the last 12 months, up 75% on a very strong run. Over the last 10 years, up 381%. And we can see they are some way away from their all-time highs of just under $90. Currently trading in the mid to upper end of the 52-week range. They do actually pay a dividend, so the first one so far we've taken a look at, 0.32%. And we can see a forward PE of 52 with market cap of 65 billion. Now, in terms of their free cash flow, it does look pretty consistent over the last 10 years. Ideally, we want to see some nice growth. Positive to note, 2025's accounts are expected to show 149, so a nice strong increase from FY24 of 118. Something just to bear in mind. Sales growth, a little bit inconsistent. Again, a lot of people will argue that this is the cyclicality of the semiconductor industry, but the first one that we have analysed that does show signs of cyclicality. 2022, 50%, very, very strong. 2023, again, very strong. Again, we want to point out 2024, they did experience a negative 7% drop to their top line. Nonetheless, it has grown from 3.64 billion to 5.51 in that latest period. And similar to the other semiconductors, they would have diluted your position if you were a shareholder from 2015, increasing it from over 300 million shares from 521 to 861. Now, in terms of the ROIC, not something that we really want to see here. We are looking for a minimum of 10% or more. So again, do factor this in when we look at that margin of safety level. 2% in 2023 and negative 1% in 2024. Operating margin, free cash flow margin. Well, on the operating side, we can see they have made a loss in the more recent period in 2024, 7% in 2023. So they are slightly struggling in terms of increasing their top line whilst also increasing their bottom line. So something just to consider. However, when we do solely look at the free cash flow margin, since 2018, some very strong double-digit numbers to their free cash flow, 18% in 2023, 19% in 2024. So free cash flow for this company is looking very healthy. Net debt to EBITDA, remember, below 1.5 for industry specific, 1.69 in 2024. So it is slightly above the 1.5, not massively enough to give it a red flag indicator. And 2025 expected around the same levels. Something to keep an eye on. But again, so far there are one or two things with this company we would say if you were a potential investor, just to factor it into your margin of safety level. So in terms of the valuation today, we get a price of around $90 as that intrinsic value. And we can see now with a 10% margin of safety, your acceptable buy would be around $81. 15% around $76, and at 20% not quite there yet. So for MRVL, we see around a 15% MOS level. Remember, these are based on the estimates and judgments we have used. In terms of Wall Street, they're looking at a price target of $90. Again, not too far off our intrinsic value. They do see this as a strong buy in the semiconductor industry with upside of 21% and that $90 price target. As always, let us know your thoughts on these companies as we go through, whether you've been adding any of them or for whatever reason, if you are necessarily bearish on the industry or these companies as a whole. The next company that we are taking a look at is ADI, Analog Devices. Now up 5% over the last year. Over the last 10 years, up 291%. Does look like one of those that has continued to increase on an upwards trend over the longer term, whereas some of the previous ones we had analysed did go up quite rapidly before coming back down and then going back up. We can see it is in the upper end of the 52-week range, and it also pays a dividend, so the second one on today's episode, with a yield just below 2%. Forward P of 33 and a market cap of just under 100 billion. Now, in terms of the metrics, well, good to know the free cash flow per share has been increasing pretty strongly from 221 to 708. Although, again, we want to point out 2024, they are expecting a dip to around $6.35. Sales growth been pretty inconsistent. Some years of phenomenal double-digit increase, like in 2022. Although we can see in 2023 it did come down to around 2%. But what you will note is that over the longer period, it has increased their top line quite significantly, around 5 times, from 2.9 billion to 12.3. Again, no surprises here. They would have diluted your position if you were a shareholder, but similar to the other 4 companies, if you were holding for the last 10 years, based on that share price return, it probably wouldn't have affected you that much. ROIC, now one thing I don't like is when we see downward trends. Not the greatest, 9% though in 2023 is something I could personally live with. Again, do bear this in mind, keep this if you are an investor or potential investor to ensure year on year, at least it isn't decreasing. When we factor in the operating margin and the free cash flow, probably the best company we have analysed purely on the margin factor. What we see here is well above the 16% for the semiconductor industry and very consistent as well year on year. Low 30s over the last 2 years. An absolutely phenomenal free cash flow machine, 29% in 2023, which was in fact one of the lowest percentages over the last few years. So looking very good when respecting the margin for this company. And the net debt to EBITDA, 1.06 in 2023. It is expected to increase to 1.5, so bear that in mind. But again, even 1.5, it is around that level that we like to see as a maximum, so not the worst. Overall, looking very strong. In terms of the valuation then of ADI, let's get to the intrinsic value. And for today's episode, it is the average of these 3 models. Remember, it does pay a dividend. We get the value of $252. Now, with a current price of $196, we use that 10% margin of safety, and we get to a price here of $227. Again, we keep going till it's near that current trading price, and we can see it doesn't justify a 25% MOS level just yet, but around 20 to 25%. In terms of Wall Street and their forecast, well, they have a price target of $212. Upside of 8%, so probably the least in terms of strength from what Wall Street see over the longer term with only 8%. But it did look like a very strong company, and our intrinsic value does show a fairly decent margin of safety level. Now, if you are someone who doesn't like to pick the stocks and you just want an ETF to cover off all the bases, then there are 2 different ETFs you could look for. You have the iShares Semiconductor ETF. Now, they both have the same expense ratio. SOXX has an expense ratio of 0.35%. There is also the Semiconductor ETF from VanEck Semiconductors UCITS. Again, a very similar expense ratio of 0.35. Now, both of them have very similar top holdings. We can take a look at SMH. Now, this one, as we can see, NVIDIA is the highest holding with around 14%. You also have some of the companies that we have reviewed today, like Analog Devices, all included. In fact, they're all included. The weighting will just be slightly different. Again, Advanced Micro Devices, 10%. If we want to look at the other one, SOXX, again, NVIDIA, slightly lower weighting at 11.2%. And in fact, AMD is their second weighting. Again, it does really depend as you as an investor whether or not you want to take on some risk or if you want to be covered by holding an ETF. Both of them have the same expense ratio at 0.35. As always though, do let me know your thoughts in the comments below. Are you adding to any of these companies? Are you bullish on any of them? And maybe whether or not you are looking at adding an iShares Semiconductor ETF or where you're looking at the other one, the SOXX or SMH. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you on the next one.